Good morning, everyone. Welcome to our Spring Statement event 2022. I'm Mark Proctor, Senior Partner at Lovewell Blake, and our speakers this morning, Colin Fish and Mary Schofield, will guide you through the key aspects from the budget announcement on Wednesday. Their presentations are expected to run through to 9 a.m. and we've allowed some time for questions and answers at the end. We're very pleased to be partnered with the EDP and to have Ken Symon, the EDP Business Editor, with us this morning. Ken will be chairing the questions and answers at the end of the presentation, so please do ask those as they come to you during the presentations using the chat function. It's great to see so many people have been able to join us this morning. Running this event virtually has allowed a wider audience to join us today, and I'm pleased to see we have around 150 people signed up to join. It's also great to be able to welcome clients and guests from overseas. It's good that running the event online has allowed us to reach you too. I'll now hand over to Ken, who will say a few words before the presentation start. Thank you.
Thanks, Mark, and good morning. Yes, it's a sunny day, but I'm wondering how sunny the Chancellor is feeling this morning with the reaction to the budget, to the Spring Statement. Obviously, it was he was working in very difficult circumstances, unusually difficult circumstances, with the state of the nation's finances after COVID. The rise in inflation, it's just hit its highest rate in 30 years. And of course, the uncertainties of the international situation in Ukraine. So that is all a pretty difficult backdrop for Rishi Sunak to be working in. But the question is, even given those straitened circumstances, did he do enough for individuals, for hard-pressed families in particular, and of course for business? It was very much, or Rachel Reeves, the Shadow Chancellor, suggested he was out of touch with a lot of people's realities. It will be interesting to see whether that kind of political attack hits home. She also said it was promising jam tomorrow, and indeed there was a lot of the Chancellor's statement, particularly in regards to business, that was heralding, was signalling what he would do down the line in terms of measures for business, measures to help business investment in particular, and that would all come, he said, in the autumn budget, when he hopes the international situation will be clearer and hopefully better, and when the spectre of inflation has started to recede, although it's 6.4% and rising to 7.4%, about 6.4% just now, I'd reckon, rising to 7 plus over the year, according to the predictions. And of course, Elements, the chief executive of Iceland supermarket, was on broadcast the other day saying that as far as food production is concerned, that inflation figure is nearer 10%. So very difficult circumstances for the budget. Did he do enough? Did he do enough for business? Be interested to hear your views and questions when we get into the Q&A session later on. But now to the presentations, and I'd like to hand over first to partner Colin Fish. Colin.
Right, thanks, Ken. I'll just put my slides up. I think my slide sharing is disabled at the moment. Thanks. Right, so you should be able to see my slides now. So first of all, I just start by welcoming everyone. It's certainly quite an unusual budget. Normally, when we have the March budget, there's normally behind the scenes a great long list of press releases that are issued on the day. So you get the headline announcements, which you hear in Parliament and see on the news, but behind that, there might be 20 or 30 press releases on a lot of sort of minor points of tax with minor tweaks, but a lot of those are quite far-reaching and they give an indication on future changes. And I think one of the big changes we've had both this time and in the mini budget we had in the autumn were that we've really not had those minor changes. It's been a much more settled tax system with everything pre-announced and not lots of little tweaks. But one thing which we have seen, which is unusual, is a tax plan, which the Chancellor hasn't done before. So I'm going to comment on some of the personal tax aspects of that during the course of this talk. So let's have a look through at the headlines. And in terms of the headlines, there were probably three quite major items. The first one is around the national insurance threshold. The second is around income tax, and that's not an immediate change. That's something that's been pre-announced and actually will fall in effectively after an election. We've got the change to the employment allowance, but the other big one is the fuel duty cut, which I think people were definitely hoping for with very, very rapid increases in fuel prices at fuel stations over the last few weeks. So let's have a look at the bits that we know about, because I always try and start off with having a look at some of the rates and allowances just to give the picture going forward. And all these have been pre-announced. And if you remember going back, the Chancellor effectively announced rates going forward for about 5 years and effectively froze them. So we know what the personal allowance is right up until 2025-26. We know the higher rate threshold up to that date. Savings rate is unchanged. And the only changes we're seeing are to the dividend rates, where with a social care levy coming in, they've all been increased by that amount, by the 1.25%. So the addition that you're seeing on national insurance, we're also seeing on dividends. The Chancellor is very aware that a lot of people that own private companies may take dividends as an alternative to salary. So they're making sure effectively that they can collect that extra national insurance equivalent from the dividends. One point obviously is if you are looking at taking a dividend, it's going to be slightly cheaper to do it in this tax year than next year, but there is a 12-month cash flow disadvantage on the tax payment. So, so it's probably actually broadly neutral. The other change that we knew about was announced in the autumn, and that was around the social care levy. Now, that's being dealt with in 2 phases. It's coming in effectively in 2022, but it's being introduced as a temporary increase to national insurance, to all of the main rates of national insurance. And that bit doesn't affect employees' national insurance for those above state pension age. But then we go to 2023, that's replaced with the social care levy, and that one will affect those over state pension age. And that is effectively to provide a ring-fence fund for the NHS. So that we knew about, but does provide some of the backdrop to the changes we're seeing at the moment, because there was a realization that the effects of those changes are going to come in pretty much at the same time as a fairly steep increase in energy prices from the raising of the energy cap. So if we have a look at the detail of what the Chancellor has said around national insurance, if we look at the current system, for employees, there's basically a 12% charge, and that applies above £9,568, and that goes all the way up to effectively the top of the basic rate band, up to 50,000, 270,000 of income. And once you go above that, national insurance is charged at 2%. That's the employee element. From April 22, we had that 1.25% increase for the social care levy. And so the rates were going to go up to 13.25% and 3.25%. And those rate changes are still happening. And that was going to apply from £9,880, which was just the normal inflationary increase to the limit. Now, obviously, that was going to affect an awful lot of people, particularly low earners, in an adverse way. So what the Chancellor has done is he has raised that threshold by about £3,000 up to the personal allowance limit, effectively up to £12,570. And anything above that will be at 3.25%. So the real effect of what he's done is to effectively exempt almost £3,000 from the employee contribution. Now, it does throw up one or two sort of oddities, because if I go back to the previous slide, you can see that that second change, the raising of the allowance, only comes in on the 6th of July. So we've got 3 months at the old rate. And that's largely around software. It's too late for the payroll firms effectively to change their software to be able to deal with the change of the threshold. So there's a 3-month window effectively. So as an employee, you're going to effectively notice a bit of an increase in your national insurance as the rates go up effectively, but then there should be a decrease effectively from July as the extra threshold takes effect. But that does throw up one or two difficulties, because, for example, for self-employed people, they're on an annual system, so a monthly rate doesn't work. So what they've done is come up with a pro rata rate, which is, in very rough terms, 9 months at the higher rate, at the higher threshold, and 3 months at the lower threshold. So that comes up with an annual rate of £11,908 over or below which you won't get national insurance. You've got a similar thing for company directors. Company directors have an annual earnings period for national insurance, so they too have that £11,908 limit. It's worth noting that there's certain entitlements, such as state pension. They depend on people earning more than the threshold, but they have basically said that if you're above the lower earnings threshold, then you're still going to accrue benefits to those, so people shouldn't lose out. It's worth just being careful around the detail of that. The other thing that is happening is class 2. If you're self-employed, you're earning less than the 12,570, then you can effectively sort of not have to pay the class 2. So that's a benefit where you would have had to before. So let's have a bit of a look at what this actually means for people on different level of earnings. So if you look at someone on a £20,000 salary, their national insurance bill would have been about £1,250 in the current year. Before Wednesday's budget, that would have gone up about £100 to about £1,340. But as a result of the budget change announced on Wednesday, that's come back down to £1,000. So instead of being about £100 worse off, you're actually going to be about £200 better off. So there's definitely a sort of advantage for someone earning at that sort of level. If you got up to £50,000, then you were going to be about £500 worse off, but that's been pulled back to being about £150 worse off. And as you go up the earnings scale, because the extra social care levy, that element has more effect, then you are going to be paying quite a lot more. So even with the extra benefit of the increase in the threshold, you're still going to be paying something like £800 more national insurance. So it very much does give support to relatively low earning people, but the high earners will be paying a lot more because of the effects of the social care levy. If we have a look at the next point, which is around income tax rates. So from April 24th, the proposal is that the basic rate of income tax falls from 20 to 19%. And I describe it as a proposal because it's obviously got to get through an election and probably an awful lot of world events, given the rate at which things seem to be happening at the moment. The benefit of that is going to be about £300 a year for a high rate taxpayer. If you're a basic rate taxpayer, you're going to get a benefit, but it depends how far up the towards the £50,000 you are as to how much benefit you get. And that is going to benefit all taxpayers. It's worth noting the social care levy only affects certain taxpayers because it affects dividends. We've seen the extra bit there. It affects anyone paying national insurance because we're seeing extra there. But for example, it doesn't include things like rental income. So if you're a residential landlord, you won't see additional payments due as a result of the social care levy, but you will get a future benefit from the income tax rate. The government's obviously aware that there is going to be an issue for charities because they effectively do a tax reclaim based on a 20% rate of tax. And if that drops to 19, that's obviously less tax they can reclaim under gift aid. So they've said that for 3 years after that change, they're going to allow a 20% reclaim to still be made. The other thing which wasn't mentioned is whether there's going to be an impact for dividends, because we've got set dividend rates which went up, and there's a set dividend rate for basic rate bands, and whether we'll ultimately see that one adjusted as well, because that all comes into that dividends versus salary type calculation. So that's the two headline tax rate changes. So if we have a look now at the tax plan, so this is something that the Chancellor included in his budget documents, and basically sets out his thoughts on where tax policy is going over the life of this Parliament. And there's three main themes, and I want to talk about two of them because those are the two that affect any personal taxpayer effectively. And Mary's going to go and talk about the other one, which is more business-based. So if we look at the personal tax changes, then effectively he has said that he wants to provide support on the cost of living. And he's flagged certain things that he's done already as being part of that. So he's made large increases to the national living wage in previous budgets. He's providing some support on energy bills through the rate system. He's just talked about the national insurance threshold, talked about fuel duty, and talk about more about that in a moment, and also talked about changes to the employment allowance. So those all come under that heading. And there's also a theme of letting people keep more of what they earn, and that's around the reduction in the income tax rate, and that's quite a big theme, but we'll look a bit more about what's going to happen on a future slide. The other thing he's mentioned around that is that he does want to make the tax system simpler and fairer, and I think one of the encouraging things is we've not seen lots of tweaks and changes, as I've mentioned in the last couple of budgets. And he had noted that there are something like 1,000 tax reliefs in place at the moment. So he wants to simplify that. There's an awful lot of reliefs that just get missed because people aren't necessarily aware of them. They're often small reliefs, but you've got to have an intimate knowledge of the tax system to be able to claim some of them. This slide sets out the effects for a taxpayer of the freezing of the allowances, because the one thing we're seeing at the moment is substantial increases, as Ken talked about, on inflation. So that is going up, and it's expected to, the annual rates of inflation are expected to slow off, but they're still expected to be reasonably high. And obviously I'm conscious that they have been underestimated and they could be higher than we think going forward. So if, for example, we take the example of someone earning either 20,000 or 60,000, which are the two examples I've got here. And if we imagine that every year they get a 5% pay rise, but that is literally just keeping pace with inflation. So they're no better off. They don't feel any better off because their costs are going up by that rate and their salary is going up by that rate. Because we've got this impact of the frozen allowances, the frozen rate bands, effectively over time, more and more of what they earn due to these pay rises is going to go into higher bands. The inflationary effect of things is actually quite a big tax raiser for the government because it does nudge people into the top rates. So if we look at next year, there's not much change. There is going to be a bit more tax deducted from people's income. This is the total tax and national insurance percentage of your income. There is going to be a bit more from a higher earner, £60,000 earner. But if we look forward to 2024-25, which is after the income tax change comes in, the reduction, we're still looking at a much bigger tax take, because whilst there is that saving at basic rate, there's an awful lot more being nudged into the high rates by that stage. So overall, people will see more and more of their income disappear in tax. So it's not necessarily the case that people are going to be keeping a bigger percentage of their income unless these thresholds do get increased earlier than they've mentioned. So moving on to fuel duty. Fuel duty is going to reduce from, or did reduce from budget day, 6 o'clock on budget day, and it was going to come down by 5p a litre. So that's happened. I did have a look as I drove past the sort of local petrol stations just to see what had happened. There did seem to be genuine reductions there. The problem is that fuel prices are just so volatile at the moment and so high that it's one of those things that it's a relatively small proportion of a litre of fuel, and people in many cases won't necessarily notice it, because if fuel is jumping up by another 5p, you may not see actually any real reductions at the pumps. The statements they've quoted are around £200 for a van driver and £1,500 for a haulier. So they are fairly material, particularly for large haulier firms. So if we have a look at an item connected with the fuel duty, and that's electric cars, one of the statistics which I did latch onto over the last few days, and I've heard more and more about recently over the last few months from the client base, is this looking at electric cars. We had all the fuel issues in the autumn and difficulties of buying fuel. We've seen substantial increases now. There's also been difficulty in sourcing diesel and petrol cars over the last few months. So what we've seen is a much bigger uptake of electric cars. I did see a statistic yesterday that said that there were more electric cars sold last year than had been sold in the previous 4 or 5 years before that. So there definitely is a substantial increase in electric cars coming through. But it's worth just flagging the benefits, because we're still at that point where there's not enough around, where the government is changing the tax system. So at the moment, they're taking their tax from company cars, which are petrol or diesel, but you get a very generous low 2% benefit in kind charge on an electric car, which is going to apply for another couple of years. There's government grants, and there's also a very quick tax relief for an electric car. So the cost of actually providing an electric car to an employee is very, very, well, it's very, very tax efficient effectively. We are going to see changes to that, because the government do have to raise the tax from somewhere, and we're already seeing a debate in the press around whether it's going to be collective from road tolls or different methods. But for now, there are definite advantages to having an electric car provided by your company, just in terms of the tax benefits. So with these high fuel prices and so on, it definitely is worth thinking around that if it's practical. On my final slide, I just want to touch on what actually hasn't changed, because it's one that we always have a lot of concern on every budget, because every year there's maybe people who are looking to sell things, and they're concerned about the rates of capital gains tax, because if you're selling a business, for example, that you've owned for a long time, and that's your sort of almost your big retirement receipt effectively, the rate of tax you pay is a huge issue. There has been a lot of concern over the recent years that the capital gains tax rate, which is 20% on everything apart from residential properties, could increase, but we've not seen an increase. We've not got any changes on the exemption, that stayed flat, and we've not seen any increases on the nil rate band, that stayed flat, and that will be raising more and more tax. But the positive news is we've not seen any adverse capital gains tax changes. And we've also not heard any more about a wealth tax. So that's all I've got to cover. So with that, I will hand over to Mary.
Thank you very much, Colin. I'll just put my slides on the screen. Just bear with me a second. Can you see my slides yet?
Not at the moment, Mary. We can now, you just need to change to your slideshow.
Okay. Think we're good to go?
You are.
Excellent, thank you very much. So, well, good morning and welcome to the business tax part of this morning's presentation. As Colin mentioned in his talk, the Chancellor published a tax plan on Wednesday, which is a three-part plan identifying tax policy for the remainder of the Parliament. If anyone's had a look at that document, you will see it's a rather brief paper, as such not really setting out a great deal specifically with reference to business tax. There is some things in there and some broader documents that the government have published, which I will spend a little bit of time telling you about this morning. So part 2 of the tax plan is, which I'm about to cover, refers to boosting growth and productivity. Now, the tax plan itself, as regards business taxes, is further broken down into sort of 3 subsections: capital, people, and ideas. And the backdrop to the plan for business tax is really suggesting that there will be tax cuts and there will be incentives for business, but unfortunately, it's pretty light on the detail. So I think, what is clear from part 2 of the tax plan is that it's a plan to have a plan, if you see what I mean. So let's think about capital allowances. So the capital part of part 2. There is going to be some reform of capital allowances during the summer. The government proposed to engage with business to seek some responses and thoughts, and these plans will be confirmed in the autumn budget. What seems reasonably clear, however, is that the super deduction, which has been with us for about 12 months and is set to end in April 23, will be phased out in April 23. Not certain, but that seems to be the way the Chancellor is moving. This is a tax relief which you may recall is only available to companies, and it's been estimated that it's costing the UK government about £10 billion per annum. So it's fairly unlikely that it will continue. You might also recall that the annual investment allowance, which had a temporary increase up to the £1 million per accounting period, which is available to companies and unincorporated businesses, is also set to be reduced in March 23. At that point, it will reduce to what's referred to as its permanent threshold of £200,000 per annum, unless any additional measures are introduced. There will be transitional rules which will take us back to the 200,000, which means that companies and businesses that's year-end spans the rate change need to be very careful indeed about capital expenditure in that accounting period, because if it's not timed correctly, you could find yourselves with a very small allowance in the part of your accounting period that falls after March 23. Now, the end of these sort of favourable tax reliefs do dovetail with the increased corporation tax rate from April 23, such that the corporation tax rate for larger businesses is increasing to 25%. So I think it's fair to say that there is very few details about where the UK government are heading with capital allowances. But given the Chancellor has suggested there'll be a tax system to reward investment, then clearly we are hopeful to have some positive announcements in the autumn budget. And what are the options for capital allowances reform? Well, in the Spring Statement document, which was published on Wednesday, which is worth a read, the Chancellor sets out in there some of the things that he is thinking about. Now, one of the options is to continue to tinker with the annual investment allowance. Since that's been introduced, it's rarely sat at its permanent level, and it's always fluctuated and been used to incentivize capex. So one of the ideas outlined in the document is to increase the permanent level of the annual investment allowance to, say, 500,000, which would be a sort of a not too generous for larger businesses, but it would be fairly simple to implement. Another alternative is to increase the rate of the writing down allowances on the pools. In the document, it suggests that from the current 18% on the general pool and 6% on the special rate pool, could consider going to 20% and 8% respectively. It's not that long ago that these were the rates, so that would just be a bit of a backtrack. It also discusses the possibility of first-year allowances. In the past, first-year allowances have typically been to incentivize smaller businesses, which obviously wouldn't be good news for the wider business community, but the possibility exists that some form of first-year allowance could be introduced. And I mean, interestingly, although I can't see the UK government would go this route, but one of the options is to fully expense capital cost in the year of acquisition. Whilst I think this would be a fabulous, nice to have, there is obviously no other country in the G7 adopt such a policy, so it's probably reasonably unlikely. So moving on to so we've talked a little bit about capital allowances. The other area that the Chancellor is looking at in terms of business taxes is people. So looking at ways to encourage businesses to offer more high quality employee training. The suggestion being that the UK lags behind its international peers with respect to vocational training. So there's going to be some sort of review and focus on whether the apprenticeship levy provides sufficient incentive to offer the right sort of training. I'm afraid there's no suggestion that the levy will be scrapped, but there's be a focus on how the apprenticeship system can work better. I think there's acknowledgement that there is quite some frustration about how the system currently operates. Again, I'm sorry to say, not much further detail on this. However, moving on to the final part of the business sort of tax plan. So we've done capital allowances, we've done people. The last bit is what the Chancellor refers to as ideas. So on Wednesday, in his spring statement, it was proposed that R&D tax reliefs will be reformed and improved. The two principal announcements from Wednesday's statement are that the definition of qualifying R&D will be extended to include further qualifying activities, for example, R&D supported by pure maths. And this is intended to provide support for innovative businesses developing artificial intelligence and engaged in quantum computing and robotics, which are particularly strong in the UK. The second suggestion, which would be very welcome, will be it's only a suggestion at this stage, is that the R&D rate for large companies could be increased. This currently stands at 13% of qualifying R&D, in sharp contrast with the payback under the SME scheme. Some businesses will recall that the large company scheme also applies for SMEs who have subsidised expenditure or notifiable state aid, for example, Innovate grants. So a hike in the large company scheme rate would be very welcome for all businesses. So I just wanted to talk you through a little bit about the rates, and I think why the Chancellor has got why he could look to increase the large company scheme rate. So currently, government statistics suggest that for every £1 spent under the, generated as tax relief under the large company scheme, this stimulates approximately between sort of £2.40 and £2.70 of additional private spend in in the R&D sector, whereas this is contrasted to, for every sort of pound of tax relief awarded under the SME scheme, only approximately brings back in about 60p to £1.20 of additional private spend on R&D. So the Chancellor is clearly seeing that tax relief in the large company scheme is generating more ongoing R&D tax relief spend. So if we just remind ourselves about how the disparity in the current rates, if you take a loss-making company under the SME scheme with qualifying expenditure of approximately 250,000, you know, the significant numerator would result in qualifying spend under the R&D tax reliefs of 575,000. For a loss-making company to surrender that back to the UK government would result in a repayable tax credit to the company of approximately sort of £84,000. So that's a rate, you know, a payback rate of 33% on the original qualifying expenditure. This is to be contrasted with a situation for a large company whereby the R&D rate being 13p in the pound means that the R&D credit would only be £32,500. Now, this is further reduced for a loss-making company to take into account the corporation tax effect. So the repayable tax credit only 26,000, so approximately 10% of the qualifying costs that the company's incurred. So, you know, so as I say, it's only a suggestion, but we hope that there could be some increased rates around the R&D tax relief. And the government has been quite active behind the scenes in its review of the R&D tax credit system in the last 12 months. There was a consultation. Following the consultation, there was the budget, and then following that, there was an R&D tax relief report, which was published in November 21. And there are three broad areas which new legislation will seek to update. So the first area is expanding the definition of qualifying expenditure to include data and cloud computing costs, specifically to include the following new categories of expenditure: license payments on data sets and cloud computing costs that can be attributed to the computation, data processing and software. The second area that the government is going to legislate for is refocusing tax relief towards innovation undertaken in the UK. So both schemes, large and SME scheme, currently allow tax relief for R&D conducted overseas, albeit that is a fairly rare occurrence for a large company given the rules. But under the current rules, an SME can engage a connected party, for example, a subsidiary company in an overseas territory, to undertake R&D on its behalf. This quite often is on the grounds of costs, because it's much cheaper to do the R&D outside of the UK. And they can claim the research and development tax credit on that cost. Going forward, once this has been legislated for, that is very unlikely to be possible. So in summary, R&D reliefs will only be available where the work is undertaken in the UK or where externally provided workers are provided, that they are on a UK payroll. Some regulatory rules may mean that R&D can continue to be undertaken overseas, but I think that is fairly unlikely to be significant for most businesses. Now, a very key area for the UK government is improving compliance and targeting abuse in the R&D sector. So the National Audit Office has suggested, and I think it was qualified in the government's accounts, that for the 2020 accounting period that estimated error and fraud accounted for 3.6% of the total cost of providing R&D reliefs to UK businesses, which equated to about £300 million. And this has to be an area that the Hmrc should address. So they've got a number of proposals which were announced as part of last year's budget and the subsequent R&D tax paper. Now, Hmrc, and we are seeing some signs of it on the front line, are devoting more resource to challenging R&D claims that they don't consider are appropriate. They're making the rules, the legislation more strict, such that it becomes more difficult for claims to be made where there is not qualifying R&D. So some of the measures which will be introduced will be that all R&D claims must be made digitally. So filing your tax return and R&D claim online and supported by a detailed report. That the claim must be endorsed by a senior officer of the company, such that all tax returns are signed by a senior person at the company saying that they believe them to be a true reflection of the company's tax liability. But I think this just slightly ramps it up a bit. A company will be required to give advance notification to Hmrc that it's going to make an R&D claim. Now, and I think this measure is really, most companies undertaking R&D, they do it every year. They've got a fairly clear business plan that includes R&D, and they know they're going to make those claims. There are obviously some companies that aren't necessarily wholeheartedly R&D companies, but are being basically approached by entities selling R&D schemes, and I think that this isn't maybe an attempt to try and wheedle those out a little bit, i.e. bona fide companies doing proper R&D will know they're doing it, can notify Hmrc. Somebody who has a bit of an afterthought about maybe taking a bit of a chance on R&D claim might be wheedled out. Of course, there will be companies that sit in the middle that might lose out because they don't do R&D every year, which is possible. There will also be a requirement to include details of your tax advisor or agent who has advised on the claim. So, making it clear whether or not you've received advice, making it clear what sort of organisation has advised you, whether it's an accounting firm or someone else. So, what next? Well, we are expecting a raft of legislation for R&D over the summer in the finance bill, and then we'll see, I expect we'll see a lot of that taking effect from April 23. And then this is really just a sort of a fairly niche announcement about business rates, which you may have heard in the announcement on Wednesday from the Chancellor. So the business rates exemption for eligible plant and machinery used in on-site renewable energy generation, and 100% relief that was announced last year for eligible heat networks that have their own business rates bill. These measures are being brought forward to April 22. And then my final slide is VAT. And I think, Rob, you were going to help us talk through the VAT changes in Wednesday's announcement.
Yep, I'm just going to try and turn my camera on. Hello, can you see me?
I can see you, Rob. Thank you.
Cheers. Morning, everyone. Yes, there was very little about VAT in this statement. Many people have commented that Hmrc perhaps missed the opportunity to support the hospitality sector with the current reduced VAT rate that's in place. They have, however, focused on energy-saving materials. So if you can think back when the UK was part of the EU, The EU actually carried out refraction proceedings against us to stop us zero rating them. Whereas now we are no longer part of the EU, so we can reapply the zero rate on the supply and installation of energy saving materials. This is going to remain in place for at least 5 years, and it removes the fairly complex eligibility conditions that had been in place before. They are also adding wind and water turbines into the scope of the relief, which is useful. But many people have said that, you know, with the rising energy prices, you know, possibly the Chancellor has missed the opportunity to reduce VAT on household bills, and focused on reducing VAT on energy saving materials instead. I think only time will tell if that was the right call. But that's it for VAT. Very little this time, which some people will be glad to hear.
Okay, thank you very much. Yeah, I'm over to, I think we're going over to Q&A session now. So please get your questions in. Colin, can I ask a question first? You mentioned in your presentation about simplification of the tax, so the income tax, personal tax position. You know, it's something that has become steadily more complex with different chancellors. I think particularly Gordon Brown, when he was Chancellor, added to a lot of complexity. Do you think Rishi Sunak's final goal in that is to align national insurance and income tax, so that rather than being two systems that sometimes kind of bat against each other, it becomes one more simpler system?
Yeah, I'm not sure. The one thing which I do perceive is national insurance is almost seen as a almost more friendly tax, which people pay because they feel they're going to get something back on it effectively. So I think he quite likes the national insurance system, and what we've seen actually is a net effect of the changes here. We've got a 1.25% increase in national insurance for people, and then a 1% reduction in income tax. So most are actually going to be fairly sort of similar. So I suspect he will actually be quite keen to keep the two, because if you merge it, it's going to be very obvious there's a very high income tax rate.
Yeah, and this is not a party political point, but chancellors of different colours have, you know, if you say we will not raise the rate of basic tax, we'll cut the rate of basic tax, and you raise other things, then it allows the wriggle room to do it. I mean, it is interesting that, you know, he does have that kind of simplifying drive, but you know, with the effect, as you were saying in your presentation, of the older or the previously announced measures coming in April, and then the new measures from this statement coming in July, and therefore that 3-month gap, which, as you explained, is because of payroll systems. But it does mean that people are going to be very confused about where their tax is, isn't it?
Yes, yeah, absolutely agree. And I think on simplification, there's such a long way to go. When I look at the amount of tax legislation there was when I started in tax quite a lot of years ago, it was covered in 2 volumes, and we now have from the same publisher 7 volumes. It shows how it's expanded over the years. Right.
And we have a question from Alan Flack, whether with the national insurance changes, is the effective lower limit for the tax year 22-23 effectively 11,820?
Well, there's a limit at which you pay national insurance, which is at that level on average effectively, but there's a lower earnings limit, which is the one where if you earn more than that limit, then you keep your entitlement to state pension and that type of thing effectively. looking at the press release, there's nothing overtly mentioned about that. So I assume that's going to stay at a similar level, which to what was pre-announced before effectively. And that level was going to be just under £6,400 a year, but it is worth keeping an eye on that. So you make sure you don't lose benefits next year by not earning quite enough. It's basically to protect people. One of the issues of putting the rate up is that people could lose access to certain benefits because they're not paying enough national insurance. So you have this lower limit where you don't actually pay the national insurance, but you keep the benefits. And say it looks as though that sort of pre-announced limit will effectively remain.
Yeah. I mean, it's I know, you know, Rishi Sunak keeps saying, "I'm a tax cutting chancellor. I'm a tax cutting chancellor," but you know, the tax rate is going up.
Mm.
Mary, can I ask you a question? I mean, with so much, you know, in your presentation, you referred to the fact that so much is still to come out in terms of changes. So both in terms of things that will affect, you know, business investment, you know, so as you said, stuff will come out on R&D over the summer in the finance bill, and the Chancellor flagged changes to come in the autumn budget. I'm just wondering where that leaves, you know, company leaders, boards, in terms of looking at what investment they do over the 6 months. You know, a lot of businesses, perhaps after having hopefully you know, coped with the effects of the pandemic and now looking maybe to invest in the future. But does this add a lot of confusion or kind of kick the can down the road in terms of what they can expect in terms of tax, and therefore how much they can invest in the business?
Yeah, I think it's, you know, at one level, you know, the Chancellor's very much keeping his powder dry, isn't he, to see how the next 6 months move along and what room he'll have to be able to, you know, provide decent capital allowances rules for businesses. But yeah, I think it's really uncertain times. You know, their businesses are sitting here with these very favourable tax reliefs, which will take us up to the end of March next year. But in reality, no clue what's coming after that, unless, you know, other than the fact that corporation tax rates are going up to 25%. So, you know, whether there's, you know, some aspect to it that is the Chancellor's hoping that people will be, you know, businesses will be digging deep for capex before the rules are phased out. I don't know, but I think it's a little bit unsatisfactory for people making business decisions.
Yeah, I mean, it's almost as if the Chancellor didn't, and I think there was some speculation in this, that the Chancellor didn't really want to make a statement this time. You know, as Colin referred to, there was not the usual kind of technical press releases accompanying the statement that actually gave you the small print, if you like, of how things would be introduced. So that wasn't there, and you know, so much of it is looking to the future. I mean, I think it was something that, again, Gordon Brown started with, not only announcing what was coming now, but what would come in a year's time. But I don't remember another Chancellor announcing what would come in 2 years' time. I mean, the change in we will cut income tax, but you know, in 2024. Sort of just in time for an election, he said, slightly sceptically. One thing we haven't touched on really is universal credit. And Kevin Gunton's asked a question: are there any changes to universal credit applicable to clients who have little or no income? Who would like to pick that one up?
My understanding is no, there was nothing in the budget which hasn't already been announced. So there were any adjustments were sort of pre-announced ones. Effectively, I'm not aware. There wasn't anything in the budget this week, effectively, that would affect that.
Yeah, I think you're right. I think the Institute of Fiscal Studies said that was one thing that they were looking for, and they didn't get. I mean, so it is interesting that, as you were explaining, Colin, the it is, the changes are progressive in terms of, you know, the 20,000, 60,000 comparison that you were talking about. But, you know, so it's slightly better for lower paid people, lower salaried people. But if you look at people who are worse off and are, you know, having to rely on benefits, there was really nothing there, and you might have expected changes, you know, at this time along with those other changes, but there was nothing there. So you know, that is an implication for different people. I mean, Rob, can I ask on VAT? So we are coming to a situation which is simplified in the sense that the physical kind of tax return, which I know is the bane of life of smaller traders, filling that in every quarter. I know some people's stress level rose enormously when they had to do that. Do you think that will make, have you had much reaction to that? Do you think that will make simpler, you know, things simpler for smaller businesses, you know, where they don't have, you know, a lot of people to work on these kind of things?
I think it's like anything. I think in a few years' time we'll know the true answer to that. As of now, I think a lot of people have embraced making tax digital. You know, a lot of people do have systems in place. I think the biggest issue we find is that Hmrc aren't always fully prepared to deal with things such as keeping the VAT number when there's a change in entity or a TOGC or something like that. But, you know, generally speaking, I think it works well. I think there should be a bit more allowance for the small business, you know, the one-man bands that you know, need 25 hours a day to run their business, let alone file and submit a VAT return using digital software. But look, it goes live for everybody from the first VAT return starting on or after the 1st of April this year. And I think a large number of our clients have signed up now or are in the process of signing up. But yeah, time will tell. I think once Hmrc system is fully operational, I think we'll see a much better feedback. Let's put it that way.
Yeah. Great. Okay, thank you. Mary, one thing we haven't mentioned so far is the business rates. I haven't gone into much of the business rates relief for certain types of businesses. So that's up to £110,000. Is that right? Can you just go through that for us?
Yes. So there weren't any additional announcements in the budget this time in the spring statement, or sort of other than the sort of provisions I mentioned. It's there's no sort of new incentives. It was pretty much what was announced last year in the autumn budget.
But does and I take your point about it being pre-announced, but does the that business rates, you know, saving on hospitality businesses, does that not come in from the start of April? Is that how I've got that? Although it was, as you say, pre-announced.
Yes. Yeah.
I mean, on the renewables, do you think that will make a big difference in terms of the renewable energy? You know, what he's done there for renewable energy, and, you know, kind of trying to help people go green and, you know, heat pumps and all that. Has you know, has enough been done on that?
Well, I think you know, if you look at the commentary in the press, I mean, no, because, you know, 5%, you know, if you're thinking about the VAT, sorry, Rob, I'm stealing your thunder. Right. I don't know how I find myself talking about VAT, so I'll stop very soon.
Carry on.
Yeah, you'll stop me anyways, won't you, Rob? But, you know, these renewable sources of energy and installation in you know, for domestic consumers, for example, you know, are phenomenally expensive. So, you know, canning the 5% VAT, I can't see is going to, you know, it'll have a sea change in people adopting renewables. There's a lot of talk in the press yesterday that really, you know, they should be, you know, tax or VAT incentives around, refurb, sort of more basic refurbs of existing systems. And, I think the sense is that it's an opportunity missed.
Yeah, yeah. And yes, and so, I mean, it seems to be a kind of general, opportunity miss being a kind of general theme. A lot of people are saying, and, while, admitting his room for manoeuvre was limited, I mean, as Colin, as you were saying earlier, Colin, the fuel duty changes, will people notice them at all, really, with the, the fluctuations in overall fuel prices? And I mean, there's been interesting some stuff about some forecourts are cutting their prices by 1p. So they're, instead of passing on 5p, they're passing on 1p, and they're saying that that's that is, the prices elsewhere have gone up, so that's what they're having to do. But I suspect people will be there'll be quite a lot of customer anger if people don't show, at least for a period, the 5p cut. But it doesn't seem very much. Yeah. I mean, what more could have been done generally, do you think? And do you think, is there, if he has more room for manoeuvre in autumn, what do you think the headline figures will be that he will do? Given that people have said there's really not very much in this, what more can he do? What more has he the wriggle room to do?
Yeah, I do think the renewables is a big thing, because I think world events at the moment is increasing the pressure for that. But I think it's one of those things that actually the biggest driver is not going to be the tax changes, which are relatively small. It's simply going to be the cost of energy, be it energy for heating, be it energy for fuel, diesel, petrol. It's going to drive the changes, because from a cost basis, it's the cost benefit equation is shifting because of that.
Right. Okay. Any other questions? What areas in the chat? I mean, it's interesting because there was, in a sense, there was so little in it that so much is coming down the road in terms of changes. Are we expecting the simplifying? Just talk to me a bit more about the simplifying of the of tax. As you were saying, basically every year a chancellor makes things, tends to make things more complicated. But it could be a real boon for businesses if the tax code is simplified, and for both individuals and businesses, if tax is simplified. Do you think he has a driving, is he really crusading on that? Is that really going to happen?
Yeah, well, whilst we haven't seen an awful lot added to the various kind of tax complications, we've also not seen much taken away. And one of the things we do notice, is people do miss a lot of the relief. So if they do their own returns, unless you spend a long time trawling through revenue guidance and so on, you're not going to pick things up. And there does seem to be more and more of an expectation from the revenue that when they bring in small tax changes, that actually could mean that in a certain situation someone's got to pay some tax, that people will be aware of these, which you just can't possibly be. So there is a huge need to simplify things, but it's not something I'm particularly seeing at the moment. It's just not probably getting more complicated.
Yeah. Sean Mary asks, with the signposted 25% rate in corporation tax and increased rates of tax on dividends, will we see a switch back, if you like, from company dividends to salary for company directors paying themselves?
I think when we've looked at the rate comparison going forward, it still is going to be slightly cheaper to have a dividend. The gap is getting narrower and narrower. There used to be quite a big gap between the two. Dividend rates, effectively, you used to effectively have a rate of 25% of the dividend would be your tax rate as a high rate earner. That's gone up to nearly 40% now. There's been huge shifts in that. So it's reasonably neutral, but it does vary according to sort of different taxpayers. So it's one where we often need to do the calculation just to check. there's not a lot in it at the moment.
Yeah, but the point that you were making about this year and then this year and last year, so but the balance with the changes, the cumulative effect of the changes is really not that, it's not that great.
No, that's right. And certainly with the corporation tax rate changing, it does narrow the gap more because a dividend is not tax deductible. So you still get you'll suffer the bigger corporation tax charge. A salary is corporation tax deductible, but then you will suffer things like the social care levy. So there are movements around, but so when you run the calculation, dividends is still very slightly cheaper.
Right. Okay. That's great. Okay, with no further questions coming in, and I'm aware that people have busy days to get to, thank you very much for all the participants. Thank you for your questions. Mark, are you wanting to say a final word?
Thank you, Ken. Yeah, just wanted to obviously thank yourself and the team at Archant for helping us support this event this morning. Obviously, as you said, thanks to all of our speakers today. Thank you to everyone for joining us. Enjoy the rest of your day.